program is made possible by PSCA, the Plan Sponsor Council of America. For over 60 years, PSCA has served retirement plan sponsors through education, advocacy, and research. Information at psca.org or at 312-419-1863.
Time and again, when it comes to market performance, many studies have shown that the average individual investor earns less, and in some cases, much less than professional money managers. Today, most of us cannot rely on a professionally managed pension to provide for our retirement. We live in a do-it-yourself 401k plan world where we need to be our own portfolio manager. But the do-it-yourself method can be complicated, and individual investors have traditionally not been able to keep pace with professional money managers. Why is that? On this episode of Money Sense, we will explore the potential explanations, learn what we may be doing wrong, and establish techniques and guidelines to hopefully correct some common individual investor pitfalls.
Welcome to this episode of Money Sense. I'm your host, Anthony Contrucci. Today we'll be talking about investing with David Park, founder and CEO of Austin Capital. David started his career in the financial services industry in 1989 and started his firm in 1993. Welcome, David.
Thanks for inviting me.
Well, thank you for being here. I'm excited to have you. Recently read your white paper, so I thought we could maybe kick it off with a discussion about the white paper, how that will be evolving into a book, I think entitled What Every Investor Should Know. And what I really enjoyed about it is how you really drill down on fees, risk, and performance. And I thought maybe you could talk a little bit about that with us this morning.
Sure. So those particular three items, we thought that the investors, by and large, needed a kind of a refresher course, and in particular about performance and in particular about risk. But as we were doing the research, what we realized was they needed a crash course, in particular about performance and in particular about risk. Fees, they kind of get. So as an example, when we were doing this, people seem to have this kind of absolute number towards performance, meaning if you're making 7%, 8%, you're kind of reasonably happy. If you're making 12, 13%, they're very happy. If they're losing money, they're unhappy. But relative to what, right? So my favorite question that I get is, hey, in 2013, I made 18%. So I would say, well, did you put 100% of your money into the stock market? And he said, yes. Well, the market made 32%. So does that mean you did well or you didn't do well? So the average investor, for some odd reason, don't have a ability to compare that to either an index or a very particular risk for some reason. So they don't kind of make that connection. So risk is something very, very elusive for them. But fees, they seem to understand. So in particular, the fees that they see coming out of their account. But if it's actually just embedded into let's say, mutual fund expense ratio, they kind of get that a little bit less. They don't really see that as a difference. So as an example, if they're paying 150 basis points or 1.5% on an internal expense ratio of a fund, they seem to be okay with it. But if they're being charged, let's say 0.2% in a index fund like Vanguard, and they get charged 1% on top of it, they see that 1% coming out, somehow they see that as a higher expense ratio than the 1.5% that's embedded in the mutual fund they don't see. So let me give you an example. One of the charts that I love showing out to folks is the impact of those types of fees. And so if we had a investor with about $66,000 account balance, which is considered to be in the financial services world a relatively small account. So if an advisor comes in and charges them 1% on that particular $66,000 account, they go, well, it's $50 a month. It doesn't seem too bad, right? But if you assume over a 30-year period of time, that $66,000 grows at 7%, and because they're saving for retirement, they're putting in $7,500 a year into that particular account, that 1% turns out to be over $181,000 in worth of fees. So if you ask the exact same question to that investor and said, do you now think that 1% is in any way reasonable, I would say about 90% would probably say no. Let me give you a different type of example. One that I like the most is called performance lag. So if you had $10,000 and for whatever reason your grandparents gave it to you when you were 15 years of age, and that $10,000 was only earmarked for retirement, so when you retired at age 65, and let's just assume that you made 10%, which is about what, let's say, the stock market has made over that period of time, you would have a little under $1.2 million. Now, if you have a 2% performance lag, or it's eaten away by fees, and you only get an 8% return, during that same 50-year period of time, we're talking about your accounts being balance being $470,000 rather than $1.2 million. So that's a
Wow.
$700,000 difference for 2%. So when we talk specifically about outperforming or doing better by 1 or 2% over a long period of time, it is a significant difference.
That's interesting. So what you're saying is, again, you used the example, overall or total performance, but that performance can be eroded not just from actual performance, but from fees as well. Because effectively, what that return is on that investment. Is that accurate?
Absolutely, yeah. Okay. And so the impact of those fees is something that I think investors should pay a little bit more attention to, regardless whether it's being pulled out of their account, they can see it, or it's pulled out before the money even hits your account in the form of an expense ratio, let's say in a mutual fund.
You can maybe talk about maybe that expense ratio for a second for our viewers that aren't familiar.
Sure. So when you invest in a mutual fund or some investment vehicle, those types of performance numbers that you see in that performance report is after expenses. So if it says that you made 8%, it may have been that they made 10%, but then after fees, after transaction costs, or after expense ratio within that mutual fund, you netted out 8% return.
So the net return.
The net return. And so you don't really see the money coming out. Whereas if you go to an advisor and then they say, you know what, we're going to manage this for you. We're going to buy individual stocks, bonds, and things of that nature. So in effect, creating a private mutual fund specifically for you because you have enough money to do so. And you see 1% being taken out. Well, that 1% is even less than the expense ratio, let's say, of a fund. But because they see it coming out, they somehow see that as a higher fee than the expense ratio where they don't see it coming out.
So maybe a little bit of a provocative question. Why don't we forget about maybe Wall Street or advisors entirely and just have our viewers, myself included, buy an index fund and hold that until retirement?
Yeah.
Does that make sense?
Yeah, it does. And that's a great question. And here's a great answer. We have something called emotions. In particular, the two emotions that's very, very powerful that drives the stock market is really kind of fear and greed, right? The fear that you're going to lose money and the fear that you're going to miss out on that return, which is really kind of greed, right? So one of the best ways to illustrate this is through a chart that we have called Managing Volatility, because really as a whole, if we were somewhat robotic and didn't really care what our money is doing day in, day out, I would somewhat agree with you. Buying and holding a inexpensive index fund and going to the end, of your goal, which is retirement, I think that works fine.
But it's us that affects that through that emotional layer that we inevitably bring to the table.
Right. And so let me show you a chart that kind of illustrates this a little bit better. So if you look at the chart where it says managing volatility, one of the things that you're going to notice is that between 1998 and 2013, there were 11 up years, 1 flat year, which means that there was no money being made in the stock market or lost in the stock market, and 4 down years. But within each one of those 11 up years, they have something called drawdown. So if you kind of take a look at this chart in the very 1998, the stock market was up 27%. But at any given point in time, if you put your money in at the wrong time, the highest point within that given year, you could have lost 19%. So that's where the trouble starts. So if you look at 1999, same thing. The market was a good year, went up 20%, but it could have lost 12% if you put it in at the absolute wrong time. So that's where the emotion starts coming in. So let me give you a little fresher, more recent number. So again, if you take away the idea of 2008 being the worst financial crisis since the Great Depression, where we not only lost 38%, but could have at one given point in time, lost nearly 50% of your portfolio if you were 100% into the stock market. The following year, the market jumped up 23%. But then look at what's called the drawdown, that little red dot on that particular chart. You'll see a negative 28%. So here you are, you lost nearly half potentially, depending upon if you pulled your money out at the wrong time in 2008. And in 2009, you see this market roaring along, but because there was so much volatility, you could have potentially lost 28% if you pulled out at the absolute wrong time. So earlier on, you asked a question, why would we ever hire an advisor? Well, if they are able to assist you in managing that volatility, here's a research from Dalbar, which they did some time ago, where they said the average investor that puts their money in a stock fund makes about 3%, when the average stock fund during the same period of time made around 10%. So that's a 7% difference because of what's called fear and greed and the emotion that goes along with all of what we do day in, day out when we're investing.
So that's interesting. And so in essence, what you're saying is if nothing else, that advisor being there, helping to maybe temper your emotions when times are good or times are bad, is really worth its weight in gold.
Yeah, and what I refer to as managing volatility, right? Not just saying, stick with it because I think it's going to get better. There has to be some way of that you're going to reduce the amount of what we call drawdown. So in that particular example, you notice that, in 2009, there was a 28% drop. But what if you were able to create a portfolio that didn't drop nearly that 28%, right? That you're only dropping 15%. And the advisor was able to create a portfolio that consistently may not reach the top 1 percentile, meaning the fact that it's going to beat the S&P 500 or trying to beat whatever benchmark you're trying to do, but try to kind of keep you into maybe not having as much volatility in your portfolio. So in the pension world, they call that an LDI strategy. In essence, you're matching up the liability, which is what the L stands for, to what kind of risk you need to take in order to meet the obligation of that pension fund, hence the liability, right? Which is in essence your income. So the way that the pension funds work is their liability is in effect your income. And if they can't manage their liability, whether they're able to achieve it in terms of fully funded so that you can have X number of dollars per month, or they take way too much risk and they lose it, then that becomes an issue for the pension managers, right? It's because you're in essence trusting them. You're kind of letting it saying, do it for me. I'm not going to do it on my own. You're doing this for me at that particular juncture. And that's really called an LDI strategy, and it's been around for quite some time.
And that stands for liability-driven investment, correct?
Liability-driven investment. It's not really, as complicated as that name would imply.
Right.
But it can be complicated because there's a lot of moving factors, including trying to manage the volatility and at the same time return.
But what it sounds like, again, it sounds complicated, but again, it's very simple because what you're saying in essence is you have that goal, so you know what the future liability is, right? That you want to be able to retire, and then you start figuring out, well, what is the present value of that, and how do I then match up to that plan, how much I'm saving, and how much I need in return in performance to help me get there.
Right. So I think one of the values that an advisor brings to the table, as you just mentioned, is the planning process. And if you kind of take a look at how we planned, let's say, before retirement, you get a paycheck, and let's say you get $3,000 a month. Right. Well, it's kind of easy to make sure, in that sense, how to plan because you can't exceed $3,000 a month. That's what you make. So you have to have an expense to match us up with that. But let's say we retired at 65 and we don't have a pension fund, right, which most of us don't. And now you have $1 million in your hand. Now plan for the rest of your life. Right? So an advisor, a good advisor, should be able to provide you not only with a pathway to determine whether or not that $1 million is enough, but based upon how much you currently have in your account, to what you can put aside, to how much risk tolerance, right, that you can take, along with how much time frame that you have. They may very well come back to you and say, we can meet our goal, or you have to take more risk, or you have to work longer, whatever they need to do. But what they are in essence doing, a part of their job, and the reason how they make their fees should be that planning process. The income at the time of retirement and trying to back into that particular number with current value, right? Present value of where you are today.
Absolutely.
And kind of manage that volatility all the way through.
Well, speaking to an advisor the other day, to your point, kind of encapsulate this concept is, for many of us, I know how much time I myself put into planning a vacation. How much time does the average American put into planning for the longest vacation of their life for retirement? Yeah,
and the unfortunate part is I would be surprised if they actually spend in any given 1 year, spent more than 3 hours out of the entire year trying to either measure and or make sure that they're actually headed into the right path, or whether they're ever going to achieve those goals. And because there are lots of even free applications out there they can find on the internet to be able to determine that, but they just don't.
Determine that goal.
Yeah, because we're busy with our everyday life. We're not saying that this is everybody's issue, we get busy with our everyday lives, children, family, and everything else. But it is a very difficult process, and I think the point you're making is most people do spend more time planning their vacation than their retirement.
Wow. Incredible. So you referenced this volatility and obviously how emotion plays into that. How is managing volatility any different than market timing? Because I know that has a really bad stigma right now out in the marketplace, this concept of market timing. Maybe you can talk about that, define it, and then talk about it a little bit.
So market timing as a whole, and in fact I was at a conference when I was speaking, and there were primarily administrators of physician offices or hospitals, and there were a bunch of physicians out there. And one of the physicians asked me the exact same question. So the way I explained it was, well, the medical industry has gone through lots of up and downs, for sure. So you don't say, well, you know what, I'm no longer going to be a doctor and come out of the medical field and then go back into it when you're feeling better about the medical field.
Right.
That would be market timing. So what an average investor does when they do market timing is they get into the market, they get out of the market. So in order for you to manage your volatility, and if you're running a small doctor's office for a hospital, you may not hire people. You may decide not to buy that particular equipment. In essence, you're managing the risk of a very active investment. Because your practice, your company is an active investment. But when you go into the passive investment, which is like a stock market, for some reason, that kind of seems to change the dialogue in somebody's brain because they're no longer in control of what's going on. All right, so if you take a look at this chart, and this is kind of my market timing chart, and for the old folks out there, like myself, you'll kind of see back in 1997, the two categories that did extremely well for many, many years was the S&P 500. And back then, it was absolutely laden with large cap growth stocks. All right, so the S&P 500, and if you look at 1998, the best performing two categories in 1998 is NASDAQ, which at that point was far more focused on technology, and the S&P 500, again, the Russell 1000, all growth, very, very heavy large cap growth. And back then, I could not get people to talk about Russell 2500, which is mid cap at small cap value, or even bond side, because they were making so much money in one or two specific asset classes, they just completely forgot about diversification. So, excuse me. So by the time 1999 hit, if you remember those days when internet stocks were doubling, tripling in value overnight. So anything with a .com was going up 50, 60, 70%. No revenue, no rule, anything else aside from a concept, and it was doubling overnight. So unfortunately for most people, when they went into the NASDAQ marketplace or into technology stocks, they went at the end of 1998 and beginning of 1999. Now look at what happens in the year 2000. So the best performing category in 1999 was NASDAQ, and the worst performing category in 2000 is NASDAQ, which is really, again, very, very technology driven. And so for 3 years running, all those people that went into the stock market, into the technology stocks in particular, and into a large extent the growth stocks that were really doing well in the prior 3 years, the NASDAQ market lost, if you look at the chart, 39% in 2000, and in 2001 lost 21%, and 31% in 2002. So people kind of had the faith, and they said, okay, well, I'm going to go ahead and think this is the bottom. And back then, this phrase was really popular: buy because it's on sale, right? Buy because something is lower, it's on sale.
Right.
And so they got into it in 2000, and by 2001, they were kind of still trying to keep the faith. By 2002, they completely capitulated, and guess where they went looking at that chart? And you'll notice in the very top of that chart, you'll see, well, back then they call it, Lehman Brothers, but as you know now, Lehman Brothers is no longer around. But the actual Barclays index, the bond side, was a top performer. Russell 2500, which is a small and mid cap, which I couldn't in any way convince people to diversify into, were the top two performing. And so they were selling off in 2001 and 2002, going finally into the bonds and mid cap value. And then if you look at the second chart, which is the market timing continued, you're going to notice the worst performing category in 2002, which was NASDAQ, is now the best performing category and made over 50%. And the best performing category in 2002, which was the bonds, is now the worst performing category in 2003. This is the reason why people lose money, and that is called market timing, because you are chasing that return. That is not managing volatility. And managing volatility is actually trying to do something in between rather than trying to reach for that top 1 percentile year in, year out. That's the biggest difference.
So that was an interesting illustration, and just to maybe connect the dots for myself and for the viewers, what it sounds like you're saying is, at the end of the day, that example you gave, the doctor in that medical practice, that you don't manage the risk or the volatility within that business model for that doctor through being a doctor one day and not the next, but really the things that you're doing. So it sounds like, with regards to investing, it'd be that asset allocation, correct? So I guess my question would be, can't you accomplish this market timing with proper asset allocation? Does that make sense?
So I think the favorite adage is diversify, right? Manage your risk, and I think to some extent it works. I think what's called a static asset allocation to some extent And in particular, where it works the best is when you're in a bull market with low volatility, okay? Just kind of like what we had in 2012 and 2013. And I have this chart here, which is used all the time to try to illustrate that diversification. And I love this chart, not necessarily because I truly believe in it, because it's used so very, very often. And so if you take a look at this particular chart, you'll see in 2007, the balanced portfolio, it made 9% in 2007. And the very, very top was emerging market equity, which is the EM equity side. And then if you look at 2008, the top performing in 2008 was Barclays Agri, which is bond funds, right? But if you take a look at that green line going up and down, you'll notice that it goes from the kind of bottom, and it kind of goes up in 2008. And that goes sideways, down a little bit, up a little bit, basically illustrating the low volatility of your average portfolio. So this is a chart that is used very consistently in every type of presentation I see talking about static asset allocation. Here's the problem. If you take a look at in 2007, the balanced portfolio made 9%. Even though the green line goes up, like it's insinuating that you're making money, if you look at the number, it's actually a negative 26%, right? And then you go sideways in 2009, it's an actually up of 19%. But most people, all they do is just kind of follow that green line, all right, assuming the fact that's what their money is doing in this particular chart. So my favorite chart to overlay on top of this chart is another chart called diversification in dollar terms. And that diversification in dollar terms is trying to illustrate what your money is actually doing during that period of time. All
Interesting.
right? All right. So on the prior chart, you'll notice that if you started off with $100,000, you made 9%. So you're now up to $109,000 at the end of that year. Well, during that given year, again, you could have been as low as approximately $93,000. So again, talking about that potential drawdown, right? So in the other chart, you see that the line goes up, but in reality, in 2008, you, at the end of that year, if you start off at $109,000, you were down to $80,000. So if you were at $109,000 in the worst crisis, albeit, right, you're down to $80,000, are you going to have a heart attack? And the worst case scenario, if you bought at the absolute wrong time and got out at the wrong time, that $109,000, you would have been getting out of with $66,000 if you sold off at the absolute worst time. And then the following year, we made 19%, according to the first chart, and you would have wound up at $95,000. But if you take a look at the diversification in dollar terms, you'll notice that in the low point, even though you started off with $80,000 and would have wound up, if you held on to it at $95,000, you could have been as low as $77,000.
Wow.
Okay.
And that's where the emotion comes into play.
That's really where the emotion comes in. And where a static asset allocation doesn't do well is in those particular market cycles, right? So that really then becomes the issue of why, as Delabar put it, there's a 7% difference between what an actual mutual fund, stock mutual fund does and what an average investor in that mutual fund will do. And if you look in the very far right-hand side, where static asset allocation really does work, you're going to notice that in 2012, you're all the way back up to $114,000, but the drawdown, the worst-case scenario, would have been $107,000.
Wow.
Okay, so that is low volatility.
Right.
And so all of a sudden, we go from fear to greed. Now they're thinking, hey, how am I going to not miss out on all these particular gains?
Big polar swings, right?
All right. So there's all sorts of different statistics of where we are today, and this is really where people go from making the mistake of fear, we're going to pull out at the wrong time, to let's put our money in maybe at the wrong time, maybe not, right?
Interesting. And unfortunately, we're out of time. We could talk about this forever. I find this fascinating. So maybe in closing, as briefly as possible, you said in the beginning of this episode that 1%, on a small account could cost an investor $181,000 over 30 years. What are some of the things that an advisor can do to justify that fee? You talked about some of the benefits, but maybe encapsulate really quick for audience some of the things that they can do.
So let's define what an investor, average three types of investor. One is, I'm going to do it totally on my own. The other extreme is I'm going to let somebody completely do it for me. But most of us are really kind of do it with me type of investor. And if a advisor just brings in a static asset allocation, I would say, I think with a fair amount of just a little bit of research on your own, you can go to Vanguard site and you actually create your own static asset allocation and save that $181,000. But really where the advisor comes into play, aside from the planning that we were talking about earlier,
that financial planning,
is the ability to actually create a managed volatility or some sort of portfolio that will close the gap of that 7% we keep talking about. So even if you get charged that 1%, right? If they can close that gap, then they pay for themselves 2 or 3 times over again.
Makes sense.
Right? So you need to be able to identify that right particular advisor. And I know we're out of time. I wish we can talk about it a little bit further because we certainly have some ways to be able to identify a good advisor over not such a good advisor.
Well, thank you very much for your time. That was wonderful.
Well, I appreciate you inviting me again.
And thank you for joining us today. I hope you learned as much as I have. We look forward to seeing you next time for a new episode of Money Sense. I'm your host, Anthony Conturci. And remember, we always try to make finance fun.
This program is made possible by PSCA, the Plan Sponsor Council of America. For over 60 years, PSCA has served retirement plan sponsors through education, advocacy, and research. Information at psca.org or at 312-419-1863. This program was produced by Lakeshore Public Media and Centier Bank.